Hi. Thanks for taking my call.
Pleasure.
I appreciate all you do. My little dilemma is that if I want to take a lifetime annuity income and get about $25,000 a year, is that better than if I take the annuity with the rider that guaranteed income that gives me $17K a year?
Okay, so one is a fixed and one's a variable. That's what you're asking about, right?
Yes.
Okay, so the fixed annuity, you're telling me, will give you how much?
$25K.
For how much of a deposit?
About $375.
Okay, so $375,000. Is that inflation indexed or is that just flat?
Flat.
Okay, and then the variable will give you $17,500 per year, but there's a potential upside and there's commutability to it. In other words, if you decide 10 years from now you don't like it, whatever's left in the contract you can take, correct?
Yes.
All right, so I think I understand what we've got going on here. You're 60 years old, Fred, is that correct?
Yes.
And what percentage of your portfolio is this $375,000?
About a third.
Good. First off, I compliment you because there is a lot of academic research to support what you're doing. In fact, Ibbotson says taking 50% of your money and buying a life annuity gives you a 99% chance of success. I don't like doing 50% in anything. In fact, I have restricted most of the people that I advise, and I advise financial planners all across the country, to about 25%, but then I look for other alternatives. This is an excellent question because we don't know what's going to happen. How badly do you need this income? Because I would suggest to you that the worse financial shape you're in terms of needing the income, the more I would be inclined to go with the fixed. And if it's marginal, the more I'd be inclined to go with the variable, because the variable, many times you can add a death benefit to it to give your heirs the $375,000 back when you ultimately die, whereas the annuity, there's nothing that comes back. So the question is, for the difference of $7,000 a year, could you buy a $375,000 insurance policy? The answer is probably not. I don't know. I haven't done the math on that. So tell me, how badly do you need this $25,000 per year by comparison?
Well, I guess the question is, if you knew how long you were going to live, then I could tell you. I don't know what the deal would be.
Is this a joint life or a single life?
It's a single.
You see, the single life, the advantage is on the fixed. I do have to tell you that. On the joint life annuity, the advantage goes to the variable, because here's what happens. The fixed number goes down when there's two of you. So the disparity is a little bit higher. I'm going to put you on hold. This is something I think we need to evaluate a little bit further and have someone actually do the math on. I think you're okay either way, but it really does have to do with how badly you need that extra $7,500 in income. And I would say, thinking about it off the top of my head, not knowing anything else about Fred, I think the fixed might be a little more sensible if he really needs the income. Now, if he doesn't, it may be that the variable would work out for him. Hang on there, Fred. I'll have someone talk to you. Let me just explain to everybody what Fred's talking about here, because a lot of this stuff can get really, really confusing. When we talk about lifetime income annuities, they come in a lot of different iterations. There is the fixed type, where you give an insurance company a lump sum. In his case, it's $375,000. And they guarantee to give him $25,000 every year for the rest of his life. Usually that comes with something called a 10-year certain period. So obviously if he dies in year 2, there would be 8 more years of payments coming to him. Now, if he dies in year 12, there would be no more payments coming to him or his family if it's a 10-year certain. If he chooses a 20-year certain, then the income number is going to go down. If it's a 0-year certain, then the income goes up. The variable annuity gives Fred the ability to invest that money in sub-accounts that sort of resemble mutual funds, and he can get real aggressive or real conservative with the money. But there is a fairly substantial fee drag. In other words, there's costs involved in the variable that are not involved in the fixed. But because the variable annuity may have automatic step-ups. If he doesn't take income in a year, the value of the income base might go up by 7 to 10%. So once again, depending on when Fred needs the income, if it's 5 years from now, the variable may make more sense. If, in fact, the sub-accounts have a big year like it did a couple of years ago, and they went up 40, 50%, then the $375,000 number is worth $550,000, and all of a sudden the income could be as much as $25,000 per year, and it can never go below that. So you get a percentage of an income base based on a high watermark value. So if early in the contract years the markets are very friendly, you're very happy because your income goes up. If not so friendly, your income can never go down, but it's probably never going to go up. Joint life, the variable almost always seems to make more sense based on what I've seen, because the differential in payments is not that high. Maybe it's $2,000 a year. Single life, when we're talking about $7,500, that's one I would have to evaluate. But eyeballing it, I would say the fixed tends to look a little bit better to me if he doesn't mind walking away from the money for the heirs. But I would not. Personally, I would drop it down to 25%, and I would look for other income alternatives that pay at least that in terms of a payout. Maybe you've got to trade off some liquidity, but hey, how liquid is a fixed annuity? Not very.